Better System Trader, episode 55.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 55, and I'm your host, Andrew Swanscott. Today's guest is a trader that has been requested quite a few times, actually. I've had a lot of requests to have this person as a guest on the show, and the guest is Adam Grimes. Adam has 2 decades of experience in the industry as a trader, analyst, and system developer, and is currently the Chief Investment Officer of Waverly Advisors. He's previously held positions at Level Partners, MBF Asset Management, and S&B Capital, and is the author of The Art and Science of Technical Analysis, Market Structure, Price Action, and Trading Strategies. For those of you that know Adam and his work, his approach to trading is a mix of quant and discretion, and I think even if you're a purely systematic or quant-based trader, it's interesting to hear other people's approaches and points of view. So we start off the chat by discussing his approach of mixing quant and discretionary models, and then we move on to behavioral factors in the markets and why approaches that look at the market as purely rational fail. We then end the chat discussing Keltner Channels and their applications to trading. So there's quite a variation in topics here, but I'm sure you'll find it interesting. But before we get started, a quick word from our sponsor, which is MarketSystemAnalyzer.com. Market System Analyzer is a software product designed to help maximize the performance of your trading strategies. It can be used to analyze and provide detailed performance statistics, find the optimal position sizing to reach your trading goals, detect over-optimized trading systems and prevent curve fitting, assess the sensitivity of trading results to trading order, and it also contains features such as Monte Carlo analysis and equity curve trading. So it's got loads of great functionality for traders, and at MarketSystemAnalyzer.com you can download a free, fully functional 30-day demo. So head over to the website MarketSystemAnalyzer.com to check it out. Or if you go to the show notes page at bettersystemtrader.com/55, I've got a link to it from there as well. Okay, let's move on to our chat with Adam. Hi Adam, thanks for joining us. It's really great to have you on the podcast today.
Great to be here.
Can we start with a little bit of background on yourself?
Sure. Do you want to start with my market background or my life outside of markets? Because there actually is a life outside of markets.
Let's hear about the life outside of the markets first, and then how you got into trading, and then what you're doing now.
Yeah, so I guess that all kind of dovetails together. My previous career and my formal education is as a classical musician. I was a composer, keyboard player, piano, historical keyboard instruments, harpsichord, pipe organ. And I did that and really just kind of dumb lucked into trading. I was with my music work. I had a certain amount of free time during the day, and I answered one of those crazy get-rich-quick ads in the mail for futures trading. It was a flyer that showed you how to start with a single cattle futures contract and eventually end up cornering the whole market by reverse pyramiding as the trend went. And I knew that it would not be that easy, but I thought I'll give it a shot. And I opened a small account and pretty quickly and efficiently destroyed it. But the experience was, there was something about it. I thought, wow, that's really, there's something here. There's something I really like about it. And so then I resolved to educate myself and to learn a little bit about markets. And along the way, I started from a very traditional technical analysis background. All of the stuff that basically, I'm sure there's some stuff out there I haven't seen, but pretty much any of the traditional technical analysis stuff I've used, and since have discarded most of that because I went through a process of really wanting to basically wanting to understand my edge, wanting to understand where it came from, how stable it was, how could I be reasonably sure that I can make money doing this for decades. And that launched me down a path of also developing some quantitative skills. As a kid growing up, I was really interested in science. And, so I had a kind of, even I think I was a little bit of an unusual musician in that I had a natural inclination toward mathematics and science and thinking rigorously like that. But my formal education did not include that. So I had to get a little bit of an education as I was also learning how to trade. So all of that kind of came together. And, over the years, my trading style evolved. I've been in pretty much every liquid market that a U.S. investor could trade in. I've traded on every time frame from very long-term portfolio construction, doing different types of fundamental analysis, quantitative fundamental analysis, to very, very short-term trading, to scalping, and to really kind of pushing the limits of what human trading can do. So that's kind of the big picture.
Okay, great. Thanks for that, Adam. Now, we might just start off with a little bit of your trading philosophy, because I understand you do have a quant side to you, but you also have a different way that you apply that. So I noticed a page on your website called My Philosophy. So I went through there, and there are a couple of interesting statements that you made. So I'd really like to ask you about those a little bit so we can get a good understanding of your approach. So
sure.
One of the statements that you made on that page that really intrigued me was, though there are many paths to investment profits, our approach is a blend of quantitative analysis and discretion, supported by a rigorous statistical framework. So I think when I read that, the last part of the sentence kind of really interested me, because using a blend of quant analysis and discretion kind of seems a little bit contradictory. So can you explain a little bit what you mean by that? What does that mean?
Well, the way to think about it. So I think on that page, if I remember correctly, I think the biggest takeaway from the page is that trading is really difficult. And, I say something about markets being very, very close to informationally efficient. Most of the price movements we see in markets are random, and it's really hard to find something that works. And I think that's one thing that if you just go, if I was coming in today and saying, hey, I want to learn to trade, I think you go to the internet and you start seeing like everybody has some super easy, super simple way to make money in the markets. And I don't think those things exist in quite the way. And, maybe there's somebody out there doing something that we don't know about, but it's really hard to make money. So then you start asking yourself, what's the best way to make money? And I think there is a widespread. There are so many different ways to make money in the markets. There are so many viable ways, ranging from purely systematic, purely rules-based, to discretionary. Now, as soon as I say, that what I've just said, of course, everybody already knows. But I think the thing that people probably don't appreciate enough about discretionary trading is that good discretionary trading is somebody who is a good discretionary trader, whether they realize it or not, they have this quantitative side. There is nobody, for instance, I don't play a lot of poker, but, I could understand the parallel. There's nobody who plays poker at a high level just by feel without having some understanding of the probabilities involved. And I suppose it's possible that you could just pick that up by playing, by being exposed to the game for a long time. And maybe there are some discretionary traders that understand the market like that. Maybe there are some freaks of nature, and I'll come back to that in a moment, that are able to process market data and truly understand the probabilities and what's happening in the market. Now, the problem is that that's not a very natural or easy thing for humans to do, because we have all of these cognitive biases. And I'm sure you've had other people talk about so many of those that really screw investors and traders in so many ways. And, we see patterns where there aren't patterns. We think things are important that aren't, we go on and on and on. So I think the best way to be a discretionary trader, the only way that makes sense to me, yeah, you can be a discretionary trader, but how are you going to make your decisions? Well, they have to be aligned with the realities of the market. And we've already said the markets are pretty close to random. It's pretty hard to make money in the market. So the only way a discretionary trader knows what to do, at least in my worldview, is if he has some understanding of quantitative structure, of the statistical background of the market. So you're making these discretionary decisions, but you understand how the deck is loaded, basically, or, you use whatever analogy you want. So that's why I do that. That's why the quantitative side is there. And my experience and belief, and there are other people who agree with this and other people who disagree with this, but I think a discretionary trader, assuming that you can discipline yourself, and I think maybe we can circle back to this, but I think a lot of people run to systematic trading because they can't control themselves emotionally. I'm not sure that's a good idea. I'm not sure that really works, but in the long run. But I think a disciplined discretionary trader will outperform a purely systematic approach in most market environments.
Okay, so how do you determine the mix there then? Because it sounds to me like there's a balance between the discretion and the quantitative side. So how do you go about determining, should that be a 50-50 arrangement or just a splash of this and that? Or how do you figure that out for yourself?
Well, I think when you start thinking about decision models, and when you start thinking about how to weigh different pieces of information, in a complicated model like this, the answer really seems to be that everything should be given equal weight. The problem is, though, that it's hard to understand the inputs. Like the average person who has not done this kind of study might want to buy a stock, and they might sit down and list 6 things that they read in some article, and they're not really 6 things. They're 6 facets of one thing, but they're weighing it as 6 different pieces of information. So the problem is you don't really fully understand, even as a, hopefully self-aware, and we cultivate that, but, a hopefully self-aware discretionary trader, you don't necessarily understand the inputs that you're weighing and the different weights you're giving them. So it's potentially it's a process that could go wrong in a lot of ways. And I think for me, the thing that really makes this work is approaching everything from from the mindset of you're just playing the odds. I have no conviction positions. I have no conviction trades. I could be. It's like a trade's a binary thing. Either I'm all in, high conviction. Not all in. Risk management is important, but you know what I mean. Either I'm on or off with the trade. There's no, oh boy, this is a trade I really, really believe in. But that can change very quickly when it's contradicted by the market. And I think the thing that's one way, and I guess I didn't really say very clearly, but what we want to avoid doing is getting emotional about a trade and really believing in a trade or really believing against a trade. How many people missed the entire last 8-10 years of the stock rally because they were afraid of the government or afraid of politics or whatever? So you simply, you have to follow the structure of the quantitative system you've set up. And the way that I do incorporate discretion is a little bit with the trade management. Do I want to have far stops? Do I want to have near stops? Are there trades where I think, for instance, if I size this based on what we see in the market, I might be understating some risks that exist that we can't really see in the return series. We can't really see in the volatility. A good example, here's a naive example, but if you were looking at let's say you were the kind of trader who gets in and you set your stop as some function of current volatility. Well, if you do that in stocks right now, you're going to be getting in long or short, whatever your system says, with a stop that is very, very close because volatility is extremely low. And so the question we ask then is that right? This is a case where a little bit of street smarts discretionary trading might nudge that stop a little bit farther away from the market, resulting in a smaller position size. So it's things like that. It's the discretionary side is really structured and disciplined by the quantitative statistical side.
Yeah, okay. So if we go to that example that you just mentioned with the stop based on volatility, couldn't you essentially test that using a quant approach and then make that a systematic rule as well? I guess another way you could say it is that perhaps the discretionary model that you're using could also be systematic, but it just hasn't been formalized yet. Maybe you're internally following the same process. So how do you get the mix, or how do you determine where you should be using discretion?
Perhaps, in the process of creating systematic approaches to trading, simple is generally better. Simple is robust. Simple has less parts fewer parameters to optimize and overfit and to go down that nightmare. So I could imagine creating a very complex rule set that might say something like, okay, we're going to set the stop as a function of volatility unless volatility is very low and meets these conditions, in which case then we're going to apply some multiplier. So we're not using such a close stop. Mm-hmm. But now I've introduced a lot of things. I've screwed with the idea of putting a stop some volatility dependent distance away is a good idea, and it's a robust idea. But now, when are you going to use this other system? What's the multiplier? How do you determine it? How do you measure the volatility? What's the cutoff? And what we're going to find is, certainly by some measures, current conditions are in some tiny fraction of 1 percentile. So our sample size, if we go back over 100 years of stock prices, and let's just say we're looking at weekly bars, we might look at 100 years of the Dow Jones, and we might find that there are only 20 or 30 previous conditions that match what we see now. So you have a really small sample size. Can you reliably create any, it could be done, but it is certainly fraught with difficulty. And then, the other question is, why couldn't we just run the system with the stop very close and know that there are going to be some outlier events and the wins could offset the losses? And, that's another discussion. And I think that's also a viable approach.
So by following this approach, have you found any particular insights using your discretion that perhaps you may not have discovered if you were using a purely quant-based approach?
Well, I think one of the things that we as humans do very well, which is also a danger in the market, is pattern recognition. The problem is, of course, we will pattern recognize when there's no pattern at all. Mm-hmm. You'll pattern recognize faces in clouds, voices in, seashell held up to your ear. And we know this. You will certainly find patterns in random data. But I have very much narrowed it's actually not very good English. I've really narrowed the universe of patterns that I look at to just a handful. And what I have found is, so these are patterns that I know have a statistical edge, and seeing these patterns evolve, seeing these patterns then resolve, monitoring momentum and mean reversion around, inside, out of these patterns, before and after these patterns might be a better way to say that, does lead to a very good discretionary read on markets. And I have found that, to me, it's a little bit of a delicate thing. So last thing you want to do is get into a social media argument with somebody about where a market's going to go. But in terms of big picture perspective, it really is remarkably easy to read stocks, gold, currencies. And by the way, the answer to market direction can be up, down, sideways, or the big one, we don't know. And that's also, to me, that's part of the quantitative lesson, is that sometimes we just don't know. And actually, most times in most markets, it is pretty much a coin flip. And but being able to see when there is an edge and being able to see the big picture flows and directions. Now, you still have to execute, and you could absolutely know where a market's going to go and still lose money trading it. It's not, that's not the end all and be all. And somebody could probably trade very well without this sense. But the thing that has surprised me is using these simple patterns in a discretionary framework really does give you a very powerful read on overall market direction.
All right, thanks, Adam. I might just move on to another statement that you've made. And it is, that statement was, behavioral factors are very important in the market. So why do you think that they are so important?
Well, I think that one of the things that changed the way that I looked at markets, because I went through a period when I tried to understand markets from a purely quantitative perspective. And, I always think of kind of the classic model of this is the person with a very strong engineering background who knows a heck of a lot more than I do about statistics and programming, and yet can't make any money in the market. And I know a lot of people like this. And I think the problem is that people approach the market as a pure math problem. Now, also, by the way, I think you can do that in certain markets and certain time frames. But the thing that really brought this together for me was understanding that market prices are set by humans. And if they're even, and I know the argument now, I just read some silly article today that said, humans aren't making decisions anymore, it's all computers. That's not true. The fact that most of the trading is computerized is true, but there's still human action behind that. Yeah. From a very naive standpoint, most of the equity executions or algos, fine, but you still have a human saying buy or sell. And if the purely algorithmic trading systems, there's still a human that creates those trading rules or creates the rules that creates the rule. We know all the ways this can happen, but there's still human behavior. If you program human behavior, then it's still human behavior encapsulated in the algorithm. And human behavior is the market is a behavioral animal. And this is why the approaches that have looked at the market as being purely rational fail. I mentioned earlier, informationally efficient. Well, we know markets are not efficient, and we know that investors are not always rational. They don't always make the best decisions, particularly at some predictable, repeatable points. Investors make the same kind of mistakes. And by the way, they've made the same kind of mistakes for the complete recorded history of markets we have, which is very interesting. We're talking not just, we have hundreds of years of good data, and then we have some pretty spotty data going back a lot further than that. And we still find some of these same stupid things. People do the same stupid things at market turns. The tulips, of course, are kind of the classic thing people talk about, but there's still bubbles, there's still excitement, people make the same kinds of mistakes. So from a big picture perspective, market prices are crafted by this interaction, I don't know exactly what the word is, but by some blend of rational analysis and emotional content. That's true in the broad market. it's very true for the individual trader or investor who's at times will find his or her decisions almost completely emotional. And people who go through the process of learning to do this will discover at times it's like they cannot act rationally. They know what the right thing to do is, but they're crazy, irrational, just out of control emotionally, they will do the wrong thing. So to me, both of those things are important. The big picture, what is the market? Well, there's a huge behavioral component, but also when it comes to the individual trader or investor, thinking about the emotional behavioral components there.
Okay, so I think you probably almost already touched on this a little bit, but when you mentioned the repeatable points where humans are irrational, how can we use this type of insight to create trading strategies or perhaps better trading strategies?
Well, it's baffling to me every time the financial media is fascinating, because everything that happens is like, this has never happened before, so we need to have a big, huge discussion. And every time there's a bubble in some asset, which, there's a bubble all the time somewhere, people act like it's never happened before or it will never happen again. And anybody, this is a case where, frankly, a naive chart reader would have an advantage over somebody perhaps with a deep economics education, because the chart reader would say, well, really, this kind of looks like this. And, that's a form of pattern recognition. This bubble we have in this looks like what we had here 3 years ago in something else. And you do see the same sorts of things. You see price becomes detached from all reasonable valuations. You see momentum increasing at an ever accelerating rate. If you look at some measure of, use some type of moving average, you see price pulls further and further away from the moving average. You see volatility increases. You will see things like if you were doing some type of order flow analysis, you would probably see that a lot more orders are hitting the offer than hitting the bid. People are buying aggressively. And then all of a sudden and dramatically, it's all over. And the momentum turns and collapses just as ferociously to the downside as it was to the upside. And that's fairly reliably the end of the bubble. Now, that's a kind of big picture structure. But if you go back and look at any number of assets from the past decade, stocks, crude oil, rates at one point, grains, sugar, you'll certainly see precious metals. You'll certainly see this type of thing happen over and over and over. And it just seems to be the way people trade. I don't know.
Okay. All right. Thanks, Adam. So I might ask you one more question before we get into some practical stuff.
Sure.
I think either in your book or your website, you mentioned that one of the suggested solutions was to try to see things from a different type of perspective. So how do you actually go about doing that?
Well, I think in some ways my approach, which is I guess I would struggle to find a word that would make sense to everybody. But my approach is relatively simple. And I think that probably differentiates it from a lot of the highly optimized approaches. I don't use a lot of indicators. I use, very simple human pattern recognition, but they're patterns that I know have a statistical edge. And I think that is a way that I have found that I've been able to make the game play to my strengths. And I think people do that in different ways. I think if there's so many different ways to do this, but the challenge really is finding an approach that first of all, has that edge, but also that you believe in and that works for you. And that's something, you kind of have to be careful when people say that, because a lot of people will say, oh, you just have to find something that works for you, as if there are a bajillion ways that make money in the market and you can do whatever you want. You just, you want to buy every day above yesterday's high. That's fine. If that works for you, just go ahead and do it. Well, obviously, it's not that simple. You have to have something that has an edge, but it also truly does have to work for you. And it has to be, that's why it's very difficult to take somebody else's approach and to follow somebody else. You can take somebody else's approach and you can incorporate it into your understanding, and you can make it an input into your own process and into your own way to trade. That you certainly can do. But I think if you had the best trader in the world calling you up in the morning and saying, here are the trades I'm making today, most people would have a very, very difficult time following that, because it's not something that they have completely been able to internalize and accept the risk with.
Mm. All right, thanks, Adam. So I might go practical for a little while now before we start wrapping up. So
sure.
I know that you use Keltner Channels quite a lot in your own trading, and you've published some research on them. So actually, before we get into that research and the applications, perhaps you can just give us a bit of a brief explanation on what Keltner Channels are and how they're different to other types of fans that are around.
So what we call Keltner channels today are not, is a little trivia here, not to get too hung up on this, but they're not what traditionally would have been Keltner channels. Keltner channels today are volatility-adjusted bands around a moving average. And what separates them from other bands is that they will use the range of the bar as a measure of volatility. So you're not looking at, say, standard deviation of return, standard deviation of price changes. You're looking at the range of the bar, and you're taking some measure of average range of the bar, and you're applying a multiplier to that, and you're setting that as bands around a moving average. That's essentially how they're constructed.
So you've done a lot of statistical research on Keltner channels. So can you share some of your insights into what you found and how that can be applied to trading models?
Sure. So one of the questions that comes up is, which band should I use? What settings should I use? Why should I use Keltners instead of Bollingers, or, on and on and on. And the answer really is, I don't care what you use. If we look at tests of Bollinger Bands or Keltner channels, we find very similar results. The concept is what matters here. And the concept is that we're wanting some volatility-adjusted measure of how far a market is from some average price. So all of your questions, simple or exponential moving average, what multiplier to apply to the bands, there has to be some degree of learning here. For instance, I'll talk in Bollingers. I think most people are more familiar with that. But, if you were going to use Bollinger Bands with a 0.5 multiplier, so they're so tight to the moving average, that's probably, I hesitate to use the word stupid. That's probably stupid in most applications. On the other hand, if you were going to use Bollinger's 10 standard deviations from the moving average, you probably have set bands that are not going to be engaged very often. So obviously there's some measure, there's some sweet spot in the middle, but it also doesn't matter whether you'll find very similar statistics if you're using 2 or 2.5 or 3, because the concept is what matters. And what we find is that so we're looking at two forces in the market. And this is I guess this is something we probably should have covered earlier. This is important. I think what shapes price movements are two forces. You're looking at the interaction of momentum and mean reversion. Now, that's not revolutionary. Everybody knows that. Everybody knows portfolio-minded people understand that momentum and mean reversion are portfolio factors. People talk about relative strength, which is an expression of momentum. But I think where my understanding is a little bit different is that there are patterns at times that can show us over some time period in the future momentum is likely to win. Over some time period in the future, mean reversion is likely to dominate momentum. And that really, to me, is what these patterns are, and what we're really looking at is being able to quantify that emerging volatility environment. Are we looking at mean reversion or momentum in the future? So having said that, there definitely is a tendency with most asset classes to reverse when they get a distance from a moving average. When they basically, just to put it in simple terms, when price touches a channel, there is a tendency for reversal. But I think you would have a very difficult time if you were going to fade every touch of a Bollinger Band. Good luck. It probably could be done with a few adaptations. You would definitely want to choose the market and the time frame you do this in, because you do see different tendencies for mean reversion, different asset classes, different time frames, and these things are kind of streaky. You'll see things that where mean reversion loses for extended periods of time. So the first thing is there's that tendency for reversal outside of a band. So we want to be a little bit careful, for instance, about buying a market that is, very strongly extended above the upper band, or shorting a market that is very far below the lower band. The other thing that we see is that these are fairly reliable indications of the type of momentum that should see continuation. So this is almost a contradiction, that if you had a situation where a market went to an upper band, made the right kind of reversal, a low volatility reversal, did not pull back much from that upper band, then there's an edge for continued momentum in that upward direction. And there's some other pattern recognition games we can play. There are things that a pattern that I've called slide along the bands, where you'll see a market push to one band and stay there. And we're talking, we're talking about visual things we see on charts, but a chart is a good heuristic that a way we can understand structurally what's happening in the market. And we've seen that in crude oil in the past couple of years several times, and we've seen that in the S&P recently. And it's one thing to be able to go back and to say, hey, look at that, this happened. But these are things that we're able to see as they develop, and we're able to see situations setting up that says, hey, this could be that type of environment. Here's what we want to watch for. So that's really and you certainly, these can be key components of developing systems. You can certainly develop systematic approaches around fading or buying or shorting pullbacks. You also can do things like set up a bunch of markets and, for instance, a bunch of stocks, and look where they fall within the band, and that's a volatility-adjusted measure of relative strength. You also can do things like measure it's a little bit backwards here because you're getting back to another measure, but people will play games like measuring the width of the bands. I want to measure volatility and other ways that I think make a little bit more sense. But for a trader just looking at charts, certainly seeing the bands become very compressed points out low volatility areas in the market. So there's a lot you can do with it. To me, it's a useful tool for structuring the data visually. But I would certainly not be the kind of trader that would say, hey, we touched the Keltner channel, so I'm going to go short. That doesn't make sense to me.
Yeah, so as you mentioned, I think Bollinger Bands are the most popular type of band, but obviously with the difference in the calculation or the formulas between Bollinger and Keltner Channels, it does produce a slightly different behavior. And have you noticed any differences between Bollinger Bands and Keltner Channels that apply to trading approaches?
So why do I use Keltner's instead of Bollinger? I guess is another way to ask the question.
Yeah.
I prefer the bands to respond a little bit more slowly to shifting volatility. And you could do that with Bollingers. You could tweak them to make them respond a little bit more slowly. I also, conceptually, the idea of standard deviation of price, that's a measure that I'm not sure is completely consistent, that makes a lot of sense. Standard deviation of returns, of course, we understand, but standard deviation of price set from an average is conceptually, it's a little bit difficult. So maybe in my thinking, there's a little bit of intellectual arrogance there. I don't know, but like I said, they test out very. If somebody is comfortable with Bollinger's, I would not at all push them to say, hey, you have to look at Keltner's. They're this much better, because I don't think they are better.
All right, thanks, Adam. I might just start wrapping up now with a few quick closing questions.
Sure.
So what is the biggest lesson that you've learned through trading?
Biggest lesson. There's so many big lessons. Trading's really hard, and I think we covered these lessons. Trading is really hard, and the behavior. No matter how quantitative you are, the behavioral, emotional aspect is still there, and it still matters.
Okay.
You need to be very self-aware.
And when you say trading's really hard, is there any particular aspect of trading that you think's harder than the other parts?
Is there any part that's easy? I think finding a method, and interestingly, this is the part that gets swept under the rug so often when people talk about trading. I think finding a method that works is very, very difficult, and that's almost maybe the hardest part. But then, once you have that method, applying it, risk management, figuring out how all of this works with who you are as a human being and your life, family, business, there's a lot of things you have to figure out.
Yeah. Okay. What do you think is the most important ingredient to becoming a successful trader?
I always love questions like this, because I just wrote in a blog, I said, okay, so I'm going to build a submarine, and you can have a pressure hull, you can have a power plant, you can have a hatch. Pick one, which is obviously you have to have all of them. And I think that's the thing that makes trading so difficult, because every little thing matters. And a lot of the, it's like you could have almost everything except some very small thing not working for you, and the whole thing is just not going to work. So to me, the thing that I think deserves a lot of respect is, and maybe it's why it's so hard to learn to trade, but everything has to work. All of the skills, all of the tools of successful trading, you have to have all of those. I don't know that one is more important than the other. You have to have them all.
Okay, thanks. And what's your favorite trading book?
I used to read a lot of trading books, and I do think that every trading book has something of value. And I can only remember a single book that I read. Then I won't tell you what it is, but there's only a single book that I thought that was a complete waste of my time. Even books that I completely disagree with, or I think are hopelessly naive, I will find something of value. It will make me think about something, even if it's a way just to kind of gut check. Oh, I think this. Am I sure about this? Yeah. Okay. Okay. That's something valuable. I have an extensive reading list on my blog that I think always kind of makes people roll their eyes, because what I would suggest is, if you want to trade, then you need to have somehow you need to have the equivalent of a basic finance and business and statistics education. So I think you need to understand accounting. I think you need to understand economics. I know you need to understand statistics. And I have a list of maybe there's 25 books there that I think people should read. If somebody wanted to start from scratch, I think I would actually point them to some of the original Market Wizards books as kind of a first step. And maybe that's a little bit of nostalgia on my part, because when I really started studying, those were some of the first books that I gravitated to. But I think in those books, there's some bad habits in those books, of course. And I think it's, you see a lot of people who started with a few $1,000s and made tens or hundreds of millions of dollars. So you get if you could read the books with the idea that that's probably not the way this is going to work for you, but the lessons of discipline, the lessons of the humbling lessons of all of the different approaches, and particularly those of us who are quantitative and systematically inclined, and some of the backgrounds that this discipline attracts, we can be very arrogant. We can be very arrogant intellectually and say, and I'm certainly guilty of this a lot of times, of saying, my way is the only way that makes sense, and if you don't see it like I do, you're just stupid. And if you look at those books and you see people doing apparently contradictory things and making money, so I think those books are good for somebody just starting.
Yeah, I think we all kind of gravitated towards those kind of books when we're starting out. Yeah. So what's the best way for listeners to get in touch with you?
Go to my blog, adamhgrimes.com. I can give you my email. You can also use Adam at Adam H. Grimes, or there's a contact form on the website. You can find me on Twitter at Adam H. Grimes. I'm just Google me if nothing else. There's an actor who also has my name, but it's pretty clear who's doing the market stuff, who's doing the acting. So if you Google Adam Grimes, I'm very, very findable.
All right. Well, thanks so much for your time today, Adam. Is there anything else that you'd like to mention before we wrap up for today?
I don't think so. This was fun. We covered a lot of topics from kind of a high level perspective, and I guess probably the other thing that I would say is I do. A lot of this was we did a lot of hand waving and a lot of kind of thumbnail sketches, whatever. And if people want to dig into some of these ideas deeper, I find that questions from readers really give me good ideas for my podcast or for my blog. And I'm certainly happy to engage people in those formats. So if you have questions, please find me and send me your questions.
Yep, fantastic. All right, well, thanks again for the chat today, Adam. It's been really fantastic to spend some time with you and speak to you about trading, so we appreciate that, and all the best.
Thank you. I enjoyed it too. Take care.
Thanks, Adam. Bye. Okay, so a big thanks goes to Adam for his time chatting today, and to those who requested that he come on the show. If you have any questions or comments on this episode or are looking for some more information, head over to the show notes page at bettersystemtrader.com/55. Also, make sure to check out marketsystemanalyzer.com for a fully functional 30-day demo of their software. And finally, if you have any suggestions for guests or topics that you'd like to see covered on the podcast, then please email them to me at andrew@bettersystemtrader.com, or you can use the contact form on the website as well. Anyway, that's it for this episode. I hope you enjoyed the chat with Adam, and I look forward to catching you at the next one. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.